In 1913, the richest man who had ever lived tried to give his fortune away, and the United States Congress refused to let him. John D. Rockefeller wanted a federal charter for something the world had never seen before, a private foundation with no end date and no limit on its power. A U.S. senator called it a menace to the welfare of society. A Unitarian minister told Congress it was repugnant to the whole idea of a democratic society. They weren't afraid Rockefeller would keep his money. They were afraid of what would happen once he gave it away. More than 100 years later, that fear has a name, and almost nobody in the wealth management industry says it out loud. Tonight, we're going to say it. Every advisor in America will tell a newly exited founder the same thing about philanthropy. They will call it a tax strategy. They will talk about appreciated stock, capital gains avoidance, and the standard deduction. They are not wrong, but they are only telling you a tenth of the story. A private foundation, structured correctly, is not a place where your money goes to disappear. It is a permanent, self-renewing institution that carries your name, your family, and your influence forward for generations. The tax break is the entry fee. The real asset is what economists call durable social capital, access, credibility, and board seats that money alone cannot buy. Princeton political theorist Rob Reich has spent his career studying exactly this, and his research traces it back to that 1913 fight in Congress. Rockefeller eventually got his foundation, not through the federal government, but through a New York state charter in 1913. And within a decade, the menace to society had become the most trusted name in American medicine, science, and education. That transformation from monopolist to public benefactor is the entire playbook, and it has barely changed in over a century. To understand the power, you first have to understand the plumbing. There are two main charitable vehicles available to a high net worth exit: the private foundation and the donor-advised fund known as a DAF. A private foundation is a legal entity you control. You name the board. You direct the mission. Your family can sit on it for generations. In exchange, federal law requires the foundation to pay out at least 5% of its assets to charity every single year, and to publicly disclose every grant it makes, according to the IRS. A donor-advised fund works differently. You contribute cash, stock, or even private business interests to a sponsoring organization, take the tax deduction immediately, and then advise, not control, where the money eventually goes. Here is the detail almost nobody outside tax law circles talks about. According to the IRS, there is no federal requirement that a donor-advised fund ever distribute a single dollar. The money can sit, invested and growing tax-free, indefinitely. The National Philanthropic Trust confirms it directly. There is no payout mandate written into the tax code for DAFs. Now here is where the two vehicles start talking to each other. A private foundation can satisfy its mandatory 5% payout by simply transferring the money into a donor-advised fund. On paper, the foundation has fully complied with federal law. In reality, the money hasn't reached a single working charity. It has just moved from one drawer to a deeper, more private one. The Baker Institute at Rice University calls this exactly what it is: a way for private foundations to circumvent the very payout rule Congress created in 1969 to stop the wealthy from hoarding charitable wealth. This isn't a theory. Bloomberg's investigative unit put a name and a number on it. Their analysis of tax filings found that hedge fund insiders at Renaissance Technologies routed close to $500 million in family foundation assets toward donor-advised funds. One of those insiders, Peter Brown, moved roughly $112 million from his foundation into Fidelity Charitable between 2015 and 2020, according to the tax filings Bloomberg reviewed. Robert Mercer's Family Foundation, which had a long public record of funded grants, shifted its largest gifts toward Donors Trust starting in 2018, a fund that does not have to disclose where the money goes next. Bloomberg's reporting notes the timing was not a coincidence. It came right after the Mercer name drew intense public and media scrutiny. In other words, the loophole doesn't just delay a payout. It can convert a fully public, fully transparent foundation record into a private, untraceable one, legally. The Aspen Institute's philanthropy advisors have gone on record saying wealth gets slower to move the larger a donor-advised fund grows, because there's no clock forcing it out the door. And because a foundation to DAF transfer legally counts as a qualifying distribution, the 5% rule that Congress designed specifically to force money out into the world can be satisfied without a single needy organization seeing a cent that year. This is precisely why 3 consecutive White House budget proposals for fiscal years 2023, 2024, and 2025 tried to close this exact loophole, and none of them succeeded. The strategy is legal, it is documented, and as of today, it is still wide open. Before you assume this is a free-for-all, understand the one line the IRS enforces with almost military precision. It's called self-dealing under Section 4941 of the Internal Revenue Code. You cannot sell property to your own foundation, lend it money, lease it your office space, or pay yourself an unreasonable salary from it. The IRS calls it a strict liability rule, meaning intent doesn't matter. If the transaction happened, the penalty applies, full stop. The first violation carries a 10% excise tax on the disqualified person and 5% on any foundation manager who knowingly allowed it. If it isn't corrected in time, that penalty jumps to 200% of the amount involved. This is precisely why every family office building, one of these structures, hires specialized counsel, because the boundary between smart legacy planning and criminal self-dealing is written in extremely fine print. Understanding these guardrails isn't the boring part of the strategy. It's what separates a durable, multi-generational institution from a future headline. Now let's look at what happens when the philanthropy is real, the checks are enormous, and the shield still doesn't hold. For decades, the Sackler family was among the most celebrated arts patrons on earth. Their name was on wings at the Metropolitan Museum of Art, the Louvre, the Guggenheim, Harvard, Oxford, and the Smithsonian. Wikipedia's own documentation of the family, drawing on New York Times and Financial Times reporting, uses a specific phrase for what that giving became: reputation laundering. The money came from Purdue Pharma and the aggressive marketing of OxyContin during the opioid crisis. Once litigation connected the family name directly to the crisis, the institutions turned. Nan Goldin's advocacy group, PAIN, staged protests inside the Guggenheim and the Metropolitan Museum starting in 2018, throwing prescription bottles into the museum's rotunda. Journalists Taylor Defoe and Sarah Cascone at ArtNet News documented internal Sackler family text messages showing they believed their museum philanthropy would stand by them through the crisis. It didn't. The Louvre erased the Sackler name from its wing of Near East antiquities in July 2019. The Met removed the family name from 7 galleries, including the wing housing the Temple of Dender, in December 2021. The Guggenheim, Tate, British Museum, and Tufts University all followed. The Art newspaper quoted Urban Institute researcher Benjamin Soskis, calling it a major milestone in the history of American cultural philanthropy, proof that even century-old naming rights can be erased. Here's the lesson this case actually teaches. Philanthropy did not fail the Sacklers because it doesn't work. It failed because the underlying business was radioactive, and no amount of goodwill infrastructure survives an active public health crisis with the donor's name directly on it. Reputational capital, it turns out, has to be built on something the public can eventually forgive. Now compare that to a family that built philanthropic influence as permanent infrastructure instead of a single, breakable brand. Since 2005, Charles Koch's foundations have funneled more than $458 million into over 550 universities and higher education programs, according to research compiled by Uncock My Campus using the foundation's own IRS filings. George Mason University alone has received well over $120 million, home to the Koch-founded Mercatus Center and the Institute for Humane Studies. A 2025 peer-reviewed study published through the American Association of University Professors examined 72 actual donor agreements between the Koch Foundation and universities, spanning 1990 to 2024. Early contracts, the researchers found, gave the foundation direct seats on faculty hiring committees. After public backlash, the newer contracts changed their language. But the study concluded they achieved the same influence through what the authors call diffuse control, funding specific named directors who run the centers instead. Inside Higher Ed reported that Koch-funded centers still shape hiring, programming, and curriculum at schools from Florida State to West Virginia University, even under the softened wording. None of this required a single dollar of political lobbying disclosure. It moved through nonprofit university partnerships, endowed chairs, and academic centers, durable, respectable, and largely shielded from the scrutiny that direct political donations attract. This is the structural difference that matters for anyone building a legacy vehicle today. A single-name museum wing is a liability sitting on your identity. A distributed network of funded institutions, chairs, and centers is a durable influence infrastructure that survives any one controversy. There is a third pattern, and it's the most important one for anyone in a fast-growing, controversial industry to understand. Sam Bankman-Fried built his entire public reputation on giving before he'd built the underlying trust to support it. Forbes reported the FTX Foundation claimed to have donated $190 million, with another $160 million pledged through its future fund. Bankman-Fried signed the Giving Pledge in June 2022. He funded university research centers at Oxford, backed pandemic prevention scientists, and became the public face of the effective altruism movement. A former FTX employee told Forbes bluntly, "Sam hides behind altruism. He's quite aware of the front that he puts on." When FTX collapsed in November 2022, the entire philanthropic structure evaporated in a matter of days. The Future Fund's own 5-person leadership team resigned as a group, writing that they had fundamental questions about the legitimacy of the operation funding them. His name was quietly removed from the public Giving Pledge website within weeks of his arrest. Grants that had already been paid became legally vulnerable to bankruptcy clawback, according to Forbes' reporting on the case. The Ohio State University's Brian Mittendorf, writing for The Conversation, drew the sharpest lesson from the whole affair. Transparency and accountability aren't the boring parts of giving. They're the only parts that make it durable. The difference between Koch's 50-year infrastructure and Bankman-Fried's 18-month mirage was never the size of the checks. It was whether the underlying wealth and the character behind it could survive being looked at closely. That is the single most important filter for any first-generation founder building this kind of structure today. Now let's talk about the part almost nobody explains clearly, how giving actually converts into access. Sociologist Francie Osterwehr spent years interviewing 99 of New York's wealthiest donors for her landmark study, Why the Wealthy Give. Her core finding: elite philanthropy isn't primarily transactional charity. It's an entire social infrastructure that determines who sits in which rooms. Her research documented something specific. Nonprofit boards in major cities deliberately expanded in size through the 1970s and 80s for one functional reason: to fit in more wealthy donors. A board seat at a major museum, university, or hospital isn't a volunteer position. It's a credentialing mechanism that places you in the same room as judges, senators, university presidents, and the next generation of capital allocators. Osterauer's research found that donors describe this access using a specific term: privileged access to prestigious settings as a direct return on their giving, not a side effect of it. This is the piece a tax advisor will never mention in an exit planning meeting because it isn't a tax outcome. It's a power outcome, and it compounds for decades in a way a brokerage account never will. This is where the strategy shifts for our second audience tonight. Founders who built serious wealth in industries the establishment still treats with suspicion. Crypto, gambling, and energy fortunes carry a specific reputational tax that traditional finance and tech fortunes simply do not. The instinct is to hide from that scrutiny. The documented pattern among durable dynasties is the opposite. Meet the scrutiny with an institution too respected to dismiss. Charles Koch didn't quietly avoid the oil and chemical stigma attached to his company. He built academic centers so entrenched in universities that dismantling them became a 15-year fight. As Unkoch My Campus's own multi-year campaign history shows, the mechanism is specific. Fund an endowed chair or name center at an institution with existing prestige, rather than trying to build prestige from a brand new entity with your name on the door. An inherited institution's credibility transfers to you as the funder far faster than a new foundation can build its own. This is also why board seats at hospitals, universities, and major cultural institutions are earned through years of smaller, consistent gifts before the seven-figure naming gift ever happens. Ostrower's research is explicit that trust precedes access, not the other way around. The Sackler case is the warning label on this entire strategy. The shield only holds if the underlying business can survive daylight. If it can, the same philanthropic infrastructure that built Rockefeller's rehabilitation from the most hated man in America into the founder of modern American medicine is available to you in a modern, fully legal form. Here's why this matters for the next 2 to 3 years specifically, not just in theory. Congress passed sweeping changes to charitable deduction rules under the One Big Beautiful Bill Act, effective January 1st, 2026, according to Holland and Knight's private wealth practice. A new 0.5% adjusted gross income floor now applies before any charitable deduction counts at all, reducing the value of itemized giving for high earners going forward. The National Philanthropic Trust confirms the same shift, noting deduction value could shrink by tens of thousands of dollars for high-income donors under the new floor. That is precisely why tax attorneys have been advising accelerated bunched contributions into donor-advised funds through 2025, locking in today's deduction value before the new rules bite. Separately, the DAF payout debate is not going away. The IRS held formal hearings in May 2024 on proposed anti-abuse regulations aimed specifically at donor-advised funds, according to reporting compiled by nonprofit sector analysts. Sponsoring organizations, the banks and community foundations that run these funds, pushed back hard and reform stalled again. But 3 consecutive presidential budgets targeting this exact loophole tells you where the political pressure is heading, even if it hasn't landed yet. The Regulatory Review's own synopsis of current scholarship is blunt. Donor-advised fund assets have grown 400% in the last decade, and lawmakers know it. Whatever structure you build in the next 2 to 3 years will very likely be grandfathered under more favorable rules than whatever gets legislated after that. The families who move now are locking in both the deduction and the structural flexibility before either one gets narrowed. So what does the actual structure look like when it's built with both objectives in mind? The tax efficiency and the influence. It typically starts with a private foundation as the permanent, named, family-controlled vehicle, the institution that carries your name for the next 50 years. A donor-advised fund often sits alongside it, used for the flexible, faster-moving, sometimes anonymous giving that doesn't need your name attached at all. NP Trust's own guidance describes this pairing directly. A foundation can be complemented by a DAF for exactly this kind of flexibility. The foundation satisfies its public 5% payout requirement with visible, disclosed grants that build institutional relationships and eventually board invitations. The DAF absorbs the larger opportunistic contributions, appreciated stock, business interests, even cryptocurrency, where NP Trust notes non-cash assets can eliminate capital gains exposure entirely. Family members can be named as successor advisors on both vehicles, according to NP Trust's donor materials, creating a multi-generational chain of control. None of this is exotic. All of it is publicly documented in IRS guidance and industry filings. What's rare isn't the structure, it's understanding, from the very first conversation with your advisor, that you are not just minimizing a tax bill. You are building the single most durable, multi-generational instrument of access and legitimacy that exists in American civic life. That was true in 1913. Bloomberg's own reporting confirms it is still true today. Every case we walk through tonight has one thing in common. None of it was secret. It was in IRS filings, Bloomberg's tax analysis, peer-reviewed university research, and congressional hearing records. The only thing hidden was the framing. The fact that nobody tells a newly exited founder that philanthropy is a power tool before it's a tax tool. Now you know both halves of it. If you're setting up your first charitable vehicle after an exit, or you're building a reputational shield around wealth from an industry the establishment still questions, this is not a decision to make from a template. I read every message that comes in about these breakdowns, and I genuinely like to hear where you're starting from. Reach me directly on Signal. The username is in the description, the Business Architect 123.43, and we can talk through your specific situation privately. Subscribe to the Business Architect for the next breakdown of how money quietly becomes power, and I'll see you in the next one.